One of the things that we look forward to in 2015, it looks like it's going to be a year of some kind of uncertainty. So how would you approach investing in a market maybe where interest rates were finally beginning to rise?
Well, John, first of all, thanks for having us here. It's important, I think, in context to understand how we approach investing. Since '97, when we started, our average leverage has only been 2 times EBITDA, as compared with over 4 for the sector. So we think about an environment of rising interest rates as something quite positive. We don't like the current environment because when debt is cheap, asset valuations get pushed up, and it makes it much more difficult to buy conventional companies with relatively easy stories, because you're effectively buying a negative interest rate option on the refinancing. So in a time like this, we look for minority deals, more complicated stories, smaller deals where we can add capital at book value. And in an environment of rising interest rates, we think that would be quite positive for more conventional control buyouts. So we would probably drift back to what I would consider as conventional investing in that kind of environment.
In an environment like the one that we're in right now, what kind of industries maybe do you look for potential deals in?
Again, I'll give you some examples, but we always look for investments with a macro thesis in mind. So we're looking for something which we think has legs in terms of growth. We're growth investors. So at the moment we are looking in optical retailing, where we have in fact a deal due to close shortly, because we think there's a real interesting consolidation story going on there, natural economies of scale. We still like building products. We have 2 investments there, one of which is quite recent. We like technological substitution within building products because that gives you an underlying macro trend along with the cycle. We're looking at craft beer, some very interesting both social and industry changes going on there, and it's a fun one to diligence. So there would be some examples of things we like right now.
All right. And obviously we've been in a bull market for a very prolonged period. How maybe might you alter your stance and the way that you invest in a down market?
So it depends a little bit on why it's down. I mean, if it's generally down, it's a bit like the question on interest rates. A lower level of valuation, a higher level of anxiety is good. I mean, it's better to invest when everyone is scared. But what we found that in down markets there usually are cyclical opportunities, and you know a cyclical investment when you see it. It's a bit like pornography. We just sold a company called Tritech, which was a company providing software to the public emergency services. And we bought it right in the trough of the Depression, when public budgets were really under pressure, no one was spending. But we figured that by buying this company, making some acquisitions, we'd be able to sell it when things look brighter, and of course that's happened. We bought Korn Ferry, a stake in Korn Ferry, in a year in which their revenues almost halved. We've done it in reinsurance, we did it in commercial finance, we bought 2 banks in the crisis. So there are very interesting opportunities which present themselves in a down market, but you don't know exactly what they're going to be until you see why it's down.
All right, well, it's a series of interesting perspectives as we get ready for the new year. I don't really often say this, so if you ever need me to help you diligence a beer deal, I'm happy to pitch in. Thanks for joining us here.
Thank you, John.